Today we're going to talk about the technical triggers which have created the best bearish momentum trade over the last 13 years. But first, some disclaimers. Disclaimer 1, this is not a solicitation to buy or sell any security ever. This is not advice. In fact, it's the opposite of advice. Quality advice and a good RIA is a great resource. We are the opposite of a forecast. Everything we are going to see here today is empirical. That means it is scientifically observable fact, and it has happened in the past. This is not advice. This is not an opinion. Disclaimer 2. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. And finally, disclaimer number 3, a reminder, note that the executions and other statistics on this video are hypothetical and do not reflect the impact, if any, of certain market factors such as liquidity and slippage, although they do include commissions of 50 cents per option contract. Let's go. So the point of what we're doing here starts with a simple observation. We've all seen magnificent charts with indicators drawn on them that we can, with our own eyes, see are in fact accurate. We can look at the prior history, look at the lines that have been drawn, look what happened in the future, and agree with intellect, yes, that worked. But the goal is not to have a pattern drawn on a single chart. The goal is to be able to pick up a pattern that has worked on 10,000 charts, hundreds of thousands of times, over decades. That is the goal of rigorous testing of technical analysis. And there are two reasons why this type of data has not been made available to the investing public. The first is that those people who have created those charts with wonderful technicals simply don't have the facility through which to test it. That is, they don't have the coding background or the machinery to apply their findings on millions and millions of data points. The second is that those institutions that do have the capability and the facility to do such research are not going to share it with the public because they're investing with it. These are the realities of technical analysis and why sometimes it feels like everyone always has a chart that looks good, but it never quite works when you try it yourself. Today, we stop that pattern of blindfolded technical analysis and we apply it to millions of data points over hundreds of thousands of backtests to give a rigorous result. By the time we are done, you will see the top performing combination of technical indicators with respect to moving averages and RSI for discovering bearish momentum in short periods of time. We have another video on discovering the bullish momentum. While we're talking about a bearish signal, it's important to remember that the market tends to go up. That is, 6 out of every 7 years on average, we have a bull market. And those 6 years far outperform the one down year. Another way of saying that is that there's generally edge in just being long the market, or there's negative edge in being short the market. So while it's good to have a balanced portfolio of some long positions and short positions with options, that doesn't mean a 50-50 split necessarily. Remember, this is what the S&P 500 looks like over the last 30 years. Yes, there are drawdowns, but in general, the direction is up. So using a bearish trigger should be measured and appropriate. It does not mean a 50-50 balanced portfolio. Let's start with another definition. A good technical bearish momentum trigger would have certain characteristics. The average trade return would be substantially larger than the average loss, and we would see that in the average return. The win rate. It has to have won more often than it has lost, or very close to it, which is very hard for a bearish strategy, considering the market on average is up 6 years out of 7. The average return, the win rate, and the average winning return are all greater than the baseline. There's no use in using extra analysis if the resulting strategy doesn't actually beat the baseline bearish strategy. So we're going to look at the idea, the application, and the results, which are empirical. Quick break for definitions. For the 10-day and 21-day moving averages, we use exponential. And for the 50-day and 20-day moving averages, we use simple. For RSI, we use a 20-day period. For all technical measures, we are using the 1-day time frame. So the idea, using charts and with them technical analysis is the most common form of financial backtesting. It is at every step using historical data to try to draw conclusions from the patterns in the past to extrapolate them in the future. That is a backtest. At some point, the analysis has to be robust. There does come a time when we have to ask ourselves if and when technical analysis adds any value to trading beyond that one chart you saw that time. That is, are we doing more than just drawing lines on a chart in coincidence? The idea is to identify a trading truth, one way or the other. Either there is a combination that meets our criteria for a good technical bearish momentum trigger, or there is not. We enter with no bias. The setup is this. We looked at the 1 year, 2 year, 3 year, 5 year, and 10 returns starting from March 2019 and going backwards, as well as the period from 2007 and 2009. Those 3 years include the Great Recession. So we have a long-term bull market and 2 bear markets. Our study group was the NASDAQ 100, and after hundreds of thousands of backtests, we landed on just 3 technical settings that we needed. We wait until the day that the stock price crosses below the 200-day moving average. This puts the stock in technical failure. We also must see that the stock price on that day has already been below the 50-day moving average. That's further technical failure. And finally, we just make sure that the 20-day RSI is above 30. We're just making sure it's not oversold. Other pieces to these backtests, we found that optimally you want to use 14-day options and a 40% limit with a 60% stop, although you see because of gaps in down markets, the average winning trades are substantially above the limit, whereas the stop loss works quite well. So just to be clear, we wait until the day the stock price crosses below the 200-day moving average, that's this setting, that the stock price is currently below the 50-day moving average, and the RSI is above 30. That's it. So here we go. Here are the average returns. From 2007 to 2009, the period which includes the Great Recession, the average trade using the baseline, which is just rolling a put every 14 days, using a stop and a limit, returned negative 11%. Since these 2-week options tend to hit their limit or stop in about 5 days, this is negative 11% every 5 days. That is nearly negative 50% per month per stock, or what would have been a total drawdown of over 600%. Alternatively, using the 3 technical settings we found and backtested, the average return was 12%. When looking at the application of these 3 technical filters, we saw that negative 11% every 5 days to a positive 12%. That is a 50% monthly return per stock, or over 600% positive returns. Over 10 years, the baseline returned negative 14%, and keep in mind now that even this model only returned negative 3%, so it was a negative trade. But let's look even further. Over the last 5 years, the baseline returned negative 9%, which would be almost a 40% loss per month, whereas the structured technicals returned 6%, or what would be nearly 25% gains per month. Over 3 years, the spread widens. Over 2 years, the spread is even larger. Over the last 2 years, the baseline showed a negative 5% average trade, whereas the structured technicals showed a positive 39%. And finally, over the last year, yes, just owning puts blindly did return 6% a week, which is quite good. But using the structured technicals, that return was nearly tripled. We can look at the average return per winning trade, and we can see the baseline is always outperformed by the structured moving average model. And now we can look at win rates. From 2007 to 2009, only 24% of stocks in the NASDAQ 100 showed winning returns in total. Using these structured technicals, 60% of the NASDAQ 100 showed winning returns in total. Over the last 10 years, listen to me now, only 4% of the NASDAQ 100 stocks in total showed winning returns over the last 10 years. Nearly half showed winning returns using these structured technicals. Over the last 5 years and 3 years, we're looking at just 12% of stocks in total in the NASDAQ 100 showing positive returns, just holding a 2-week put and rolling it every 2 weeks. Whereas using the structured technicals show win rates over 50%. Over the last year, we do note that the baseline had a higher win rate, but if you recall with the returns, the structured model showed almost 3 times higher returns. So that's it. This was our setup. We looked at 1 year, 2 year, 3 year, 5 year, and 10 year returns, as well as the period from 2007 to 2009, which included the Great Recession. We did find average returns that were substantially larger than the average loss. In other words, the average return was positive. The win rate, it has won more often than it has lost. The average return, the win rate, and the average return for the winning trades are generally much larger than the baseline. This has worked in a bull and a bear market. And finally, here's a summary of the findings as you would apply it in Trade Machine. The day the stock crosses down through the 200-day moving average, the stock price is already below the 50-day moving average, and the 20-day RSI is above 30. And finally, to apply this in Trade Machine, we'll go to the Pro Scan tab. We can choose any ticker group we like, but in this case, we'll choose the NASDAQ 100. We go to Bearish Technical Bursts, We'll pick a familiar name like Amazon. Here are the results over the last 2 years. We can go to 5 years. And we can add some of our other favorite tickers. We'll look at Amazon and Facebook, Electronic Arts and Applied Materials. We can see over the 5 years, these stocks, while they've all been up substantially, this bearish trigger has returned substantially positive results, all with win rates above 50%. Keep in mind this is over a 5-year period, and some of these have only triggered 7 or 8 times, so that means this trigger will only happen 1 to 2 times a year per stock. That's exactly how it should look during a bull market. Now let's look at the 1-year time horizon, and we're seeing win rates all above 50% and substantially positive returns, but in this case, in the last year, for example, Amazon has triggered 4 times rather than 1 time. So when we hit a bearish bump in the road, this trigger will start firing and alerts will let us know when it's time to take a look at this backtest. We can also look at the last 6 months. And even in the last 6 months, Amazon has fired 4 times, meaning during a bear market, it's been a trigger about every 1.5 months. Thanks for watching.